Okay, thank you very much for joining us this afternoon. We have a very distinguished panel today to talk about managing capital flows in this world of quantitative easing and very, very low interest rate structures in the G3. We have Dr. Alan Bullard, who was formerly the governor of the Reserve Bank of New Zealand. We have Marcus Roederer, who is currently the mission chief for the IMF for China and the deputy director of the Asia and Pacific Department, and Credit Suisse's own Lito Camacho, who was formerly Finance Secretary of the Philippines. What I'd like to do, to try to get this going, is just to try to do a little round robin here to define the problem that seems to exist. There's a tremendous amount of noise coming out of governments and in the press about currency wars. I tend to think that's a bit of a misnomer, but perhaps starting with Marcus. Marcus, what would you define as the problem that's generating this sort of controversy and turmoil?
For some time now, we have seen capital flows to emerging markets really increasing and being very strong, and we see several factors at work here that cause that. Many are fundamental and here to stay. Some are cyclical. First, we have better prospects in emerging markets, better growth, better policies than in the advanced economies. Second, we have a different cyclical position, as we all know, reflected in different monetary conditions. Very weak growth right now, zero interest rates policies. Even that also is not just a very short term. We expect it to be there for a while. And third, of course, we have many policy changes in the advanced economies that have reduced tail risks. European Union breakup, tail risk removed, fiscal cliff improving, and of course the recent policy changes in Japan. So the combination of these three factors have pushed capital flows out towards emerging markets. So there's really two questions about this. A, how strong are these capital flows? And B, what to do about it? In terms of how strong when we've looked at the data up until very recently, of course we do see an increase, but I would also say it's not a tsunami. Basically, capital flows to emerging markets are more or less back to where they were before the crisis. So it is an issue, but we don't see it as a huge issue. And that's also why our managing director, Lagarde, you may have seen her saying, we don't see evidence of currency wars, we see evidence of currency worries.
Now, that's sort of an EM perspective. Certainly, there's an advanced economy element to this as well. Particularly for smaller advanced countries. Dr. Bullard, what's your perspective on the extent to which there's a problem, if there is one, and how you would define it?
Yeah, well, I think there is a problem. Countries like New Zealand have a very tough time out of dealing with the quite second-best conditions that they face, in my view, as a result of some of the quantitative easing that's been going on in the larger economies. The indication that will continue for a long time, that it might be hard to get off that in turn limits the possibilities in smaller open economies, and also in a setting whereby all our economies are trying to go through change and rebalance, and at times one really gets the feeling that you have been shoved out of place in the queue to do this, perhaps rightly, but nevertheless problematically. At the same time, we're seeing a number of the larger developed economy central banks taking over sort of ersatz fiscal policies and ersatz bank regulation sometimes, and sometimes capital control type areas. And that does really change the game and make it quite difficult for some of the more orthodox central banks that want to remain orthodox while they can. And there you've really got limitations, I think, on what you can do. You can try and get into capital controls, but that's a very difficult area for open economies with decent financial sectors. You can just bear it, which is how I interpret what Australia's doing. Now, of course, they're doing it in response to very strong commodity prices, but they're suffering big contractions in parts of their sectors as a result of that, which is sort of the OECD advice, which is what you've got to do. New Zealand's tried to do it through orthodox monetary policy, but more and more saying, well, what other options are there in terms of macro-financial policies or macro-prudential policies, and have recently done a lot of work on that, and maybe they end up in that space, I don't know.
I mean, Lito, from a an ASEAN, Southeast Asia perspective, how do you think about this?
I think it's an issue that's certainly creating a lot of concern and dilemma for many monetary policymakers and finance ministers around the region. In a way, it's ironic because I remember, when I was finance minister only 10 years ago, I would have loved to have this problem of having an appreciating currency, low interest rates at that time. Today, our central bank governor in the Philippines is struggling because he's looking at purely at the level of the central bank, where he has a very simple balance sheet. He's got foreign exchange, mostly US dollars on the asset side, and he's got Philippine pesos, on the liability side. And Philippine peso interest rates are, higher than US dollar interest rates. So year in, year out, since this thing has started happening, the central bank's been losing tons of money. Where traditionally, it's been quite easy to make money as a central banker. So I think he's faced with that. Aside from the fact that the inflow of capital, mostly through the financial markets, either equity or bond markets, for many policymakers, they can be schizophrenic about this because they're not sure if it's really helping the real economy. And so is it money that you want or money you don't want? And so that's the other issue. And for the real economy, certainly at this time, it would be hurting if you're an export-oriented economy like many of the Southeast Asian countries, or in the case of the Philippines, where there's a lot of reliance on overseas Filipino workers, remittances, for example, or the business process outsourcing industry, which has emerged in the Philippines. An appreciated peso makes it very uncompetitive, say vis-a-vis India, where on the other hand, you've seen the rupee depreciate, you've seen the Philippine peso appreciate. So on a competitive basis, it makes the Philippines looking less competitive in that space. And for overseas Filipino workers, which has really been the foundation of the domestic consumption story for the Philippines, it certainly hurts that the peso has appreciated some 10, 15% just in the last year or so. So I think for Asian central bankers, Southeast Asian central bankers, this is really quite a tough situation to be dealt with.
Now, of course, the problem is that it's going to continue for quite a while. And we were told that last night, in essence, by both the FOMC statement, but also the press conference that came after that. It's clear that at least Fed policy is going to remain very easy for very long. Australia and New Zealand are important parts of the region, so I don't want to just focus on EM. The IMF has changed the way that it thinks about management of capital flows substantially over the last several years. It has said that intervention, taxes, outright limits are at times appropriate. If we start with developed markets, advanced markets, and thinking of small open economies ranging from the UK to Australia, New Zealand, their rate structures are already low. Even in the UK now, you have some signs of some degree of speculation in property. So some of the macro-prudential, some of the orthodox macro-prudential recommendations, cut rates, allow a strong currency, don't seem to apply anymore. In an advanced country context, what would the recommendation set in general be from the IMF?
Well, as you rightly said, the fund over the last few years has looked at this really as a problem that can't be addressed by just one single measure or one approach. We do have the macroeconomic options, of course, that are there, but as you said, currency may already be appreciated, current accounts may already be in deficits, interest rate may already be low, the economy may be close to overheating, reserves may already be very high, so intervening and sterilized intervention even is not really an option anymore. So then you have to look at what are the other areas, and there's, as you have mentioned, macro-prudential tools I think are an important line of defense. And we have the various categories of credit-based, liquidity-based, capital-based tools. And, as a supporting measure, clearly capital flow management measures, which means capital controls in a sense, can play a role in supporting the right macro policy stance. That is the view of the international community as reflected in the recent consensus that came out in the fund. So still, we want to be very careful when we say capital flow management measures, capital controls are appropriate, because you do need to see this as a package. You do need to see it as a support. It's very hard. Once you do this, there's issues of exit. We know that these are regulations, and the longer you keep them in place, markets try to get around them and arbitrage. So it is with care and with caution, but they do certainly play a role if they are temporary, if they are well targeted, and if they're in support of a broad policy package.
Now, I mean, the G7 and the G20 have seemed to come out very firmly against the idea of intervention. Again, thinking about developed markets, I mean, would the fund suggest that countries such as Australia and New Zealand could at times justify intervention or even capital controls?
Well, in the end, of course, it's the choice of the country. And if a country has set a great store in a very open, for example, a floating exchange rate system, it has to be very careful to change that policy framework lightly. So, you know, there's not a one-size-fits-all. But clearly, if reserves are not very high, there is room potentially for some foreign exchange intervention to smooth the adjustment of an exchange rate that otherwise could move abruptly and could really undermine external balance and the framework.
Dr. Pollard, New Zealand has actually intervened somewhat, not very recently, but you know, in the recent history. I mean, what's your perspective on how you're supposed to deal with this?
I think this is quite a big problem. I think it's an institutional problem. It's also even a theoretical problem. If you look at what economists have managed to do since World War II, I think we've gone a long way on things like inflation management, a long way on things like fiscal management, but really exchange rate issues we haven't. And in fact, if you go right back and read about Bretton Woods, same problem there, and it's never really been dealt with, in my view. Where's the IMF today? You're doing spillover reports. That's really useful, although I'd like to see them get more attention. But are you strong enough on the sort of story that you're putting out with some of the big G4? We don't see it from where we are. G20, yeah, they didn't actually come out against currency manipulation. They came out and said we shouldn't be involved in currency for anti-trade or manipulative purposes. I thought the communique that came out from Moscow wasn't particularly strong at all. It certainly implies that there's going to be currency issues going on. Provided you don't think you're doing QE to get your currency down, then G20's got nothing to say to you. Bank of International Settlements, well, it was sort of a convention. You didn't talk about exchange rates there, although we did set up a small economy group, and that talked a lot about exchange rates. It's a real issue for small, good policy economies, and it's in risk of degrading their policy framework. And I'd say that for countries like New Zealand and for countries like Philippines as well. It's a very hard one to deal with. Yeah, we've intervened slightly in the exchange rate, but you know, I sat there yesterday through the BlackRock presentation and heard how much funds he's got under management. Well, we don't fool ourselves like that, what the market is like. New Zealand's tensions in the past, I'm no longer in position, but in the past were always, you could do a very small amount, if you're lucky, at the top and the bottom of the cycle. You can't change things beyond that. We're realistic.
So, I mean, you know, for, say, Australia, New Zealand, the UK, I mean, as a central bank governor, does that really push you toward managing the implications of the flow just through effectively credit controls of various forms or other macro-prudential measures?
Yeah, I mean, capital controls very difficult for those sort of countries. I'm interested you put the UK in there. I've just put UK in my group of quantitative easing countries with the impact, whether or not they intended that, of the exchange rate.
Well, they had, the reason I throw the UK in there, and I agree with you right now, it's seen its currency weaken quite substantially. It had a period there a year or 2 years ago when, because of credit risk perception in the euro area, sterling was arguably too strong, you know, relative to sort of the monetary policy settings, et cetera. And so it was a country that was, you know, there was a flood of money going into the UK because, well, you couldn't buy anything in Europe. What's the next, you know, AA, AAA, large bond market that you can buy into? And, you know, you default outside of Japan and the United States into the gilt market next. Then you work your way down to Canadian government securities, and then you get to Australia, and then you get to New Zealand. And all of those guys have received very substantial flows as a result of, in part, the Eurozone stress.
Yeah, well, I mean, in New Zealand, we did look at macro-financial policies as a possible addition to monetary policies, very much second best, or maybe it's third best. We looked at things like core funding ratio adjustment, counter-cyclical capital, changing risk weights on different sectors, and loan-to-value ratios. As of when I left late last year, none of those have been put in place. We thought they might have a role for a short term in a difficult world. We didn't have great expectations about them beyond that. But you know, central banks will keep looking at things they can do and be realistic about it.
I mean, Lito, if you think about the Philippines right now, FX reserves have gone to record levels, well in excess of external debt. I mean, I think the Philippines now could pay off its entire external debt and still have FX reserves left over. A result of that is the money markets are absolutely flooded with liquidity, such that T-bill yields have been well below the policy rate for a couple of years. And yet the liquidity continues to come in. And as you noted, the cost of sterilization is very high. I mean, what do you see as policy options here?
Well, first, I think, you know, on the one extreme, foreign exchange controls, I think you can throw that away. I think it's not something that will be considered, certainly not from a Philippine context. I think people understand that it's a one-way street that you have to take if you do take that. You know, it's not a policy direction that you can reverse quickly and expect that the market will forgive you and you know, you're back to business as usual. Although, having said that, I think of Malaysia, what they did in 1998, maybe Malaysia's proven that to be a wrong
it took them a few years to come back. But,
yes, but they were able to come back eventually. So I think what they do is, you know, the only options available to them would be tweaking with different tools. Intervention for sure. I'm sure, you know, Philippine Central Bank, as most central banks, you know, around the region would intervene. But as they would say, it's not to intervene to change the direction of the currency, but to change the speed of that direction, to moderate the speed by which it might appreciate or depreciate, you know, one way or the other. I think they will use monetary policy as the central bank in the Philippines has done. You may know that they've just recently reduced the rates on special deposit accounts. You know. They will also do it with some other restrictions. For example, the special deposit accounts had been used or abused, as they might say, by foreign investors, and through different mechanisms been able to go and earn, you know, abnormal rates from the central bank. They've closed that window. They may also introduce certain measures to limit the credit, availability of credit. So putting restrictions on banks and what they can do in real estate lending, in other forms of lending. So I think they will be using a variety of tools as they have been. But it's really just coping with the issue. I mean, it's not solving the problem that you still have this massive flow of capital. And that's why it's a struggle. It's a real struggle.
In this, there's some sinners and there's some saints. You know, the saints I might identify in the emerging market universe as some of the countries that have actually allowed currencies to appreciate quite a lot. Some of those have turned into sinners, I might imagine. So Brazil might qualify as one. The Philippines in the region would qualify as one that's allowed quite a lot of currency appreciation. And there's some others that are definite sinners within Asia, some near and dear perhaps to your heart. I mean, what can be done to level the playing field across the guys who are allowing flows to move currencies and drive adjustment, and those who, you know, quite clearly aren't? Because there's some very large players who aren't.
Well, you know, I think you need to see this in a balanced way. And when you listen what the IMF is saying, I want to just also put on the record, we're not just talking to emerging markets. I think we also have to see that there is a role that advanced economies can play, even though we're somewhat in the corner because the situation is what it is. But even while we are in this very weak growth situation, you know, we're looking at fiscal policy, for example. We're saying very clearly there is a role for the United States, for example, and for Japan to really put in place credible medium-term fiscal adjustment plans, which will help either to smooth the fiscal adjustment programs that they have, it will raise the credibility, it will reduce the burden on monetary policy, or repair your financial systems faster than you're currently doing. That also should help take the pressure off monetary policy sooner than otherwise. So now, of course, our traction with advanced economies and with surplus economies traditionally is our advice and recommendations. It's not the same as our traction is with deficit and problem cases, but we do speak loudly also that there is a role for advanced economies to try to make this situation but now let's also not forget that this loose monetary policy, everybody agrees in the room, I'm sure, is critical for the health of the world economy. I think none of us is arguing that we need to do that otherwise. Now, in emerging markets, I think it's not an issue of fairness or otherwise. I think each country has to find the right balance. To what degree do they want to separate their own monetary policy, their own systems from the global economy? There may be countries like Hong Kong is maybe a corner solution where you don't have the option, you have no exchange rate, you have a totally open capital account, so by definition you are adopting the monetary stance of the world, of the US dollar. So the only option is to accept that and try to deal with the unavoidable liquidity consequences as they're trying to do. Macro-prudential policies try to rein in the exuberance that might come because you do have a monetary stance by fiat that's really not appropriate for your cyclical position and particularly not for what's happening in certain sectors. Other economies may choose to let the exchange rate go as much as possible and have the flexible exchange rate as the separator between the monetary stances. Depends on your external position, depends on how much room you have to intervene again, how much you want to then go into, other than exchange rate appreciation, go to macro-prudential regulation and capital flow management. As Lito says very clearly, these are not lightly taken decisions because in many of those countries, New Zealand perhaps again is a prime example, going down the path of using regulation to drive in wedges between global and home markets seems like a small step when you do it piece by piece, but it is a big step because it deviates from the policy framework. It can't be done lightly. But then also when you see that you have already appreciated a lot, you can't go that far anymore, and you see pockets of instability emerging, and you see certain markets really taking off, a lot of froth, there is no option but to use all the tools that you have to keep it back and to maintain the system stable as much as you can. So I don't think it's an issue of fairness between different countries. I think it's an issue of what is the right balance between the three major options that you have: exchange rate adjustment, macro-prudential policies, and maybe capital flow management more directly.
I mean, if we look at Asia specifically, most of the region, not all of it, most of it runs a current account surplus. Credit growth across the region has been quite strong, and if I think about China, if I think about Korea, Korea feels that it has a household debt problem. Certainly there's been a credit boom in China. Monetary policy is probably about as easy as it makes sense to have it. Is the problem that the region's fiscal policy, with one or two exceptions, is just simply too tight? I mean, if you think about the surplus economies. I'm asking you, and yeah.
Well, we are looking at the region, and we are just about to come out in a month or so with our annual update of our regional outlook, and we do see that it is time for the region to sort of turn towards really holding back emerging signs of bubbles. We don't really see it yet as a global, as a region-wide phenomenon of froth and exuberant credit. I think we see pockets here and there in certain markets. There's different issues, of course, in China. So it is time, I think, for policymakers to increasingly pay more attention. How can we hold back our economies through various tools? Again, it differs very much from country to country. We can talk about China, but also I don't want to, just monopolize this.
Sure.
I don't think one can just say fiscal policy is too loose across the region. I don't also say we can say monetary policy is too loose across the region. But I think there is a need and countries are doing it. You see the various macro-prudential measures that are being adopted throughout the region. I think it's the right it's the right approach to look very carefully and try to hold back what we do see as an emerging potential for exuberance, in particular in certain markets, real estate, housing, you know.
I mean, Lito, if you think about a lot of the options that you tossed out for the Philippines, you know, a lot of it falling into the macro-prudential area. You know, if you had your finance secretary hat on and you were thinking about growth and you were thinking about revenues, you're increasingly restricting bits of the economy by saying, you know, right, we're going to limit the extent to which housing can grow. We're going to limit the extent to which credit can go into this area. What do you think of as cost to having a policy framework that, you know, increasingly is more complex?
In the case of the Philippines, it's not as much an issue because there are new drivers of growth that has emerged in the Philippines. So I don't think the Secretary of Finance today would be as concerned. If anything, I think it helps him on his fiscal position because obviously interest rates are very low. Government's still a big borrower in the market, so to that extent, it's helpful. So I don't think he's facing that dilemma where, you know, if it were between him and the governor, he might be asking the governor to moderate whatever policy tools is being used by the central bank. I think he would be as concerned with the governor on the impact on some of these challenges, on the currency appreciation, on the real economies, you know, the workers, BPO industry, and now a growing manufacturing sector in the country. So I think he would be aligned with the interests of the governor.
Dr. Bola, do you think that roughly applies to, you know, how, say, Australia and New Zealand would think about macro-prudential, you know, the kind of creep of macro-prudential regulation through the system?
Well, I think countries like those that have done reasonably well from inflation targeting are sort of listening to all the noise about is inflation targeting still the appropriate frame. Generally thinking, well, it is, it's what's there. How can you do things that might improve this quite unusual situation we're in? Are we in this unusual situation for a long time? And do that without causing policy damage. So are we into an environment where more economies would be saying, yes, it's longer term, low interest rates, plus something else. But the trouble is the plus something else's aren't very attractive. And I'm not seeing a lot of evidence that macro-financial policies have worked terribly well. I mean, they have some impact, but that they're particularly effective at working. Actually, I'm not sure that quantitative easing, the evidence is there that it's necessarily having all the impact that as some people are suggesting. I see Mervyn King in a sort of a takeoff of Zhou Enlai, said he'd like to see 300 years of data before judging whether quantitative easing was going to work. And that's probably right. So we're in rather difficult territory in that sense. We've always, while I was at least central bank governor, we were saying, well, it's a while till we get back to normal, but we will get back to normal. Now I suppose people are saying, will we get back to normal? And if so, you know, is that a paradigm change or not?
Well, it certainly seems like the stock of quantitative easing is more likely to increase over the next 6 months than decrease. It looks like Japan's going to do more. And, you know, I think more people would expect the BOE to do more rather than not do any more. And the Fed has told us they're going to keep going at the current pace. So the problem is just going to get worse.
Yeah, but against a slightly more positive macroeconomic environment where we're seeing more growth in the US, I mean, after all, it's been growing for a number of years now. So for some of those countries, are they going to continue with quantitative easing even with a return to growth, albeit not a return to some of the levels that they enjoyed before the global financial crisis?
I'm quite conscious of the time, so what I thought I might do is just open it up to the floor for questions. Does anyone have a question? Maybe we start at the front.
Well, I would like to ask how central banks should be concerned about the losses stemming from FX, foreign exchange intervention and the negative carry, given that the central bank doesn't have the solvency issue, right? If we look back in the past, the Bank of Chile and also Israel, they can still conduct monetary policy effectively during the era of having negative net worth. So, and also they have the sterilization tools to keep the monetary base stable. So should they still keep the hands in the foreign exchange market until the QE ends, maybe a couple of years later, or they are facing more limitation in terms of the leeway for further fiscal, further foreign exchange intervention?
Lito, I might suggest, the Philippines is a perfect example of this, having had a central bank that did exactly that in terms of being able to manage monetary policy, even with some degree of.
Well, I think they will have to continue doing what they're doing in terms of quasi-intervention for as long as this challenge is facing them. Notwithstanding the fact that I can share with you that last year, I believe I'm told that our central bank lost $100 billion, 100 billion pesos, or about $2.5 billion in their P&L, and they had lost maybe a slightly smaller amount the year before. If you go back to 1992, we had to reconstruct our central bank. New Central Bank Act came to effect that recapitalized central bank, because the central bank at that time became capitally impaired. So it's a challenge that I don't think they'd want to push it to the extreme where that has to be repeated. But in the meantime, I don't think that they have much choice.
Just to add to that, I think it's quite hard to generalize. There's a lot of very different models when it comes to central bank accounts. I know that the Bank of International Settlements has gone through and surveyed all of this, and it's quite hard to find patterns in there. Seem to be central banks that work quite well with very positive equity and some with negative equity. You do have to weigh it up against the whole relationship of the central bank to the broader government accounts and the degree of autonomy that's in there as well. That is quite different across a range of areas. But I can tell you, at least in the case of New Zealand, we had one year where we made a loss on FX holdings. It was pretty uncomfortable. I didn't like it at all. It changes the dynamics within a central bank, maybe more than it should.
I think if I may just add to what Alan said, because I recall that when we did reconstruct our central bank, its independence became paramount in the new law, precisely because of the situation that was forced upon when they were less independent.
I mean, I guess the issue here is that at a very technical level, as long as the sovereign is perceived as being solvent, that the central bank doesn't need any capital at all. What I think Dr. Pollard, you're referring to is that, and Lito, is that there are nonetheless intergovernmental fiscal relations that are very important. The central bank that has capital and is profitable has a stronger seat at the table when dealing with the Ministry of Finance than otherwise, or the government.
You don't want to go back to your Minister of Finance and your Treasury
asking for capital.
Recapitalization.
Yeah. Other questions, please? Yes, ma'am.
My question is for Dr. Allen. And there is a speculation that the Chinese RMB will depreciate. And what is your opinion or your perspective on this feature of this currency, please?
I think the question is, do you have any particular
what I
view of the RMB?
Yes, I do, and it's that I can't forecast it, and nor can you, and nor can most people in this room, although I know some of you make money off trying to make money off it. Exchange rates are a big problem because they're a badly behaved variable that is very hard to find robust determinants, very hard to forecast short term. We felt we could forecast some things medium term to a minor extent, and that's not how economists want prices to behave, but that's the world. So sorry, I can't really answer your question beyond that.
Any additional questions? Yes, please.
There's one at the left.
There's one on the left as well. Okay.
Hi. Thank you for your time. The question for the panel is, because of what you mentioned, are the constraints regarding exchange rate management. Do you foresee G20, the G4, or sort of a broader group going to suggestions that have been made in the past where there might be restrictions on a country when the trade surplus exceeds a certain percentage? Do you foresee some sort of grand bargain happening in the next few years because of all the trade wars that we are anticipating and currency wars or worries that are being talked about?
Well, as you know, there is the G20 understanding that a plus minus 4% trade balance is sort of something that's within the range that you can say is consistent with fundamentals, and anything larger than that. But I don't, frankly, personally foresee anything that goes, certainly not beyond that. And neither does this G20 understanding have any real tooth and bearing at this point in time. At the same time, as you know, the fund now, the IMF produces an annual update of how we see external balances in the global economy. We have, even though what, of course, the governor says, the methodologies and the economics of it are very tricky and are almost intractable, but we have made progress in developing an analytical framework to assess external balances and exchange rates. And while clearly we had a very clear judgment that things were really out of whack 2, 3, 4 years ago, where we had fundamental significant undervaluations of the renminbi, where we had overvaluations on the other side. Last year we came out with a statement where we had seen these imbalances narrow, where we came out that there was still some moderate undervaluation of the renminbi, some moderate overvaluation of the Japanese yen. But again, and I come back to what I said before, despite the noise and the big talk about currency wars, despite the undeniable, very large effects on small open economies, globally, we do not see a huge, very large, significant global imbalances, neither on the current account side, nor do we see, at least in a measurable way, huge imbalances in capital flows. We are close to what you might call something that's consistent with fundamentals, pretty much, both in the dollar, the euro, the yen, and even the renminbi. And in about 2 months or 3 months, sort of in the summer, when we do our Article 4 consultations with the systemic economies, in parallel to that, we will do an update of our external sector report with a refreshed assessment.
I think we've got a question over here.
Bank of Japan, Bank of England, US Fed, even none of them are explicitly targeting any currency moves. But the Swiss National Bank is, and the balance sheet has gone to about 100% of GDP now. So what is IMF's thoughts on that?
What was the question?
I mean, do you want to touch on that? I mean, I guess that would fall, if I look at what the IMF's written, that would probably fall under the heading of, a special case where intervention is justified.
Of course. Well, we're not here to talk about the Swiss case in particular, but I think it's certainly one of the choices of a small open economy that has taken a stand and has decided we have done a lot. We have put a limit on how far we can go on accommodating these drives through the exchange rate, and they're trying everything else to try to rein it in. But of course, given the underlying forces that are there, it's not easy, and the costs of intervening and of sterilizing are very large. So that is precisely one of the limits of sterilized intervention, despite the questions that one might have of how effective it really is. In fact, we've done a study recently where we looked how effective is actually sterilized intervention, and what we find is, from an empirical point of view, in the advanced, again, it's not a one-size-fits-all, but in the advanced economy, it's very interesting that actually it's very hard to demonstrate any effectiveness of sterilized intervention, because in advanced economies, with all the developed markets, I think the conventional wisdom borne out by the study is if you intervene, you have to tell the market that you're willing to change the stance of your monetary policy. And if you continue to sterilize, you're not doing that. So we don't see any significant effect of sterilized intervention in advanced economies. We do see a significant effect in the emerging markets. For some reason, their markets are still somewhat more segmented from the immediate offset. But when you sterilize, you come in, get in more money. So we do see some effectiveness of smoothing the appreciation. But if you take it from a longer viewpoint, these studies also don't show any impact on the level of the exchange rate in the long run. So again, sterilized intervention can be for many economies a tool to smooth, to delay, to postpone, to slow down the pace of appreciation, the real appreciation of a currency, but it's not a fundamental solution.
Dr. Bowler?
Yeah, I wouldn't mind betting that every small open economy advanced economy in the world has done a study of Switzerland and come to the conclusion that they don't want to do or can't do the same thing for a range of reasons.
Andre, speaking for Credit Suisse, I don't think that I would allow to answer that question.
No. Do we have any other questions? Yes, sir.
In the Japanese context, how do you think about the maximum size of the central bank balance sheets? Like, what metrics are you looking at when you're reaching unacceptable levels? And especially, you mentioned the link to sovereign solvency for Japan. They're reaching levels as a percentage of GDP that obviously is going to accelerate. Is there metrics that you would point to saying, well, these levels would get unacceptable, or size to GDP, or what metrics do you look at?
We don't see it that way, frankly. Japan, I think, has a history of deflation they have been trying to get out of. At least they've been saying so. We do support, and I think the international community broadly does support the effort of Japan to make another serious attempt to get out of deflation. I think the fund is on the record for some time that we felt the previous attempts of the central bank were not strong enough. So we do support that. However, at the same time, we have to say, they've done also a new fiscal stimulus package, which at the very least, this fiscal stimulus package has to very quickly, very strongly be supported by a credible long-term, medium-term adjustment plan. Because the risks of sliding into another expansion and not having a credible medium-term adjustment plan when you have a public debt that's already very high, and the solvency of the whole situation really depending on low interest rates is, of course, a huge risk out there. And even the effectiveness of what you're trying to do on the monetary side depends a lot on the credibility of the whole framework. And you can't have a credible framework if you don't know where your fiscal balance in the medium term is going. So I think it's a worthwhile attempt. We support it, but it has to be really supported very soon by a credible medium-term fiscal framework that, for various reasons, both effectiveness of the monetary measures and the credibility of the medium-term plan.
Any others? Okay, well, I might pose one last question at the risk of possibly picking a fight among our panelists. To Dr. Pollard and to Lito, I get a sense of a disagreement in the sense of the fund concluding that the world is kind of roughly along the lines of fundamentals, but at an individual country perspective, that's not how it feels. I mean, what do you think the problem is? Why are we getting this disconnect between kind of a global, holistic view and an individual country perspective?
I think it's a sort of a G20ization of the problem in a way, and G20 thinks it represents the world, and of course it doesn't. So a lot of these issues just aren't coming up at those institutions.
I agree. I think the at the G20, at the G4 level, they're looking at the global concern, the global stability. At the level of the country, it looks very different. It looks much more real. You're dealing with more real problems, at your country, and therefore, being imposed an understanding at the G20 level is not very satisfactory because it does not solve your problems, in your own neighborhood. So, I think it's one that leads many monetary policymakers, central bankers at the country level do things that they otherwise would prefer not to do, but they're forced to do because that's what's being imposed upon them.
Right. Okay, with that, we started a little bit late, so I might call it an end to the session early. I'd like to thank our panelists for their comments and being quite frank in willing to sort of disagree with each other at times. Thank you very much.
Thank you.
And thank you for joining.